All right, let's jump straight into this high-octane breakdown of the June 4th, 2026 crypto crash. Welcome to The Explainer. Today, we're cutting through the noise, separating the short-term panic from what's actually a massive, long-term institutional sanctuary forming right before our eyes. The screens might be flashing red, but the structural shifts happening beneath the surface, they're completely wild. Just look at this scouter reading to kick things off. Our fear and greed index has absolutely plummeted to an 11. We are talking extreme, pure fear here, as Bitcoin dives below that $63,000 mark, driven by some record ETF outflows. And the on-chain data? It's brutal. Short-term holders, anyone who bought in the last 5 months, have hit their worst capitulation of 2026, dumping roughly 53,000 Bitcoin onto exchanges entirely at a loss. It's a full-on siege. So let's break down exactly how this is happening in Phase 1, the siege underway. First up, we have a massive psychological blow. MicroStrategy, Michael Saylor's absolute titan of a firm, just broke its legendary never sell rule. They liquidated 32 Bitcoin to raise about $2.5 million. Now, logically, out of a $56 billion portfolio, that is literally a drop in the bucket. But psychologically, it absolutely shattered the vibes. It signaled to an already terrified market that even the most diamond of hands might actually be flinching. And while that panic sets in, there's a huge momentum shift happening. Bitwise's Matt Haugen hit the nail on the head when he said artificial intelligence is just sucking all the oxygen out of the room right now. We're watching this massive risk-off rotation where capital is fleeing crypto and running straight into AI and robotics. I mean, Marvell surged over 40% after NVIDIA's CEO called it a potential trillion-dollar company. So crypto is being forced through this incredibly painful, liquidity-draining metamorphosis. At the exact same time, we've got these rapid-fire external shocks acting as mechanical triggers for the market. Geopolitically, tensions between the U.S. and Iran are escalating, with U.S. forces disabling an oil tanker and Iran responding with missile strikes, which led directly to the U.S. Treasury sanctioning Iran's largest crypto exchange, Nobitex. And to top it all off, a massive legacy supply ghost just woke up. Mt. Gox's wallets moved over 10,000 Bitcoin, that's roughly $739 million, reminding everyone that the October creditor repayment deadline is looming. So, looking at this perfect storm, we really have to ask ourselves, is this a fatal blow, or is it a calculated contrarian pivot? Because in these markets, maximum fear usually masks maximum opportunity. Which brings us to Phase 2, the sanctuary's power level. Because while retail is running for the exits, the institutional data is telling a completely different story. A recent BNY Wealth survey shows an unbelievable 74% of family offices are now exploring or actively invested in digital assets. That's a huge leap from just 53% back in 2024. Generational wealth isn't treating this like some speculative experiment anymore. They're treating it as a foundational asset class. And when you break it down by region, Asian family offices are really leading the charge here with aggressive 5% allocations. Meanwhile, the U.S. and Europe are taking a slightly more cautious, but highly strategic approach, building momentum with allocations around 2.5 to 3%. They aren't panic selling, they are quietly deploying capital. But here's the catch. This quiet accumulation absolutely relies on robust regulatory frameworks. Over in the EU, the MiCA regulations are essentially forcing a massive natural selection process. By setting up super strict standards for custody and operations, it's flushing out the non-compliant players and leaving behind a rock-solid institutional-grade infrastructure where big money feels safe. And that safety net? It is triggering explosive integration from traditional finance. The legacy giants aren't running away during this crash. They're building. MoneyGram is launching its own MGUSD stablecoin. Stripe, Visa, and MasterCard are heavily developing stablecoin platforms, with MasterCard already settling USDC and PYUSD across major chains. They are literally hardwiring crypto into global payments while everyone else is distracted by the daily charts. We can even see this contrarian energy on-chain. Right in the middle of this massive retail sell-off, institutional entities like BitMine are going the exact opposite direction. They just quietly scooped up over 26,000 Ethereum. They're totally ignoring the short-term chaos and just aggressively buying the dip. Why? Well, they're looking ahead at Ethereum's 2026 roadmap. With the Glamsterdam upgrade coming in the first half of the year and Higatah in the second half, the network is targeting massive scaling and throughput capacity. Smart money is betting on that future infrastructure, not today's fear. Which leads us perfectly into Phase 3, fundamentals over vibes. Ultimately, what we're witnessing here is a painful but totally necessary evolution. The market is shifting away from being a pure momentum trade, the speculative vibes, the retail hype that's so vulnerable to crashes, and it's turning into a contrarian bet. The future belongs to regulated infrastructure, rock-solid institutional custody, and undeniable fundamentals. So as we brace for what will likely be another 48 to 72 hours of extreme price instability while the market absorbs this Mt. Gox and institutional selling pressure, I want to leave you with this. When the dust finally settles on this market siege, will you be holding a momentum ghost or a foundational asset? Thanks for tuning into The Explainer. Stay focused, ignore the noise, and I'll catch you next time.